Dear students, Assalamu alaikum wa rahmatullahi wa barakatuh. I hope everybody is doing well and in good health. Today our topic of discussion is weighted average cost of capital, or simply you can call it WACC, WACC. As you know, this topic is one of the most important topics we have in finance, right? And all the students who are related to the field of finance or have an interest to learn something about finance must know the concept and the idea of weighted average cost of capital, or simply WACC. So dear students, this is really very much important topic in finance. Today I'm just simply trying to explain what is WACC and how does it work in finance. Okay, a company has different sources of finance, right? Okay, company has different sources, alternatives or options of finance, namely common stock, retained earnings, preferred stock, and debt. What does this mean, dear students? It's clear. Companies, when they try to make financing, right, so they have number of options or alternatives. You can say sources of financing. They can choose among common stock, retained earnings, preferred stock, and debt. But whatever source of finance a company select, right, to raise fund from, the company has to pay something in return other than retained earnings, because this is a type of internal financing. So if you want to raise fund by issuing common stocks, right, which we call it equity financing, then you have to pay some minimum cost, right? That is not for free. Or preferred stock, you have to pay the cost. Or debt, the debt is not for free. Like if you want to raise funds from creditors in the form of issuing debt securities, short term or long term, we have bonds, we have T-bill, T-notes, and different types of debt securities we have. Or simply you are just acquiring loan from banks, so you have to pay what? Interest in return. That is called the cost. Okay, so dear students, whatever source you are selecting, right, to raise fund from, you have to pay the cost too, right? And that is called the cost of capital. But in today's lecture, you try to figure out how much is the average cost you are paying to each source of financing. For example, if you try to create a capital structure, form a capital structure where there you need to raise fund, right, from shareholders, right, equity financing, you try to do the equity financing or debt financing, then you try to know how much is the average cost you are paying. For example, the cost of the common stock is 10%, the minimum cost you have to pay to the shareholder is 10%, right? The minimum you have to pay to the preferred shareholder is 8%, and you have to pay interest 6%. So we have 10, 8, and 6%. If you wanna know how much is the average you are paying to each source of financing, or in other words, to figure out or compute the average cost paid to the each dollar risen against the each dollar risen, right? So that is what we can compute by the help of WACC. That's why the WACC formula developed. Okay, dear students. Okay, what is WACC? That is the average after tax cost of all the sources we have. It is calculated by multiplying the cost of each source of finance by the relevant weight and summing the products up. Okay, this is the formula for computing the average cost, weighted average cost. This is looking a little bit scary, but I'm just gonna make it very much simple for you. Don't worry about it. Okay, dear students. Okay, practically I'm just letting you know how to compute the WACC. Okay, we have an example here in Excel. I have just copied here. Here is a company, and this is a company try to compute the WACC. Okay, first you should know the company has two sources of financing. One is equity, another is debt. In this example, the company is issuing 1 million shares, right? It means the company has equity financing. And here the company also issue how much? 50,000 bonds. It means the company is having a debt financing. Now, in today's example, you are learning the average cost the company paid to both of these financing, and that is what is called WACC. But before, I'm just trying to explain what we have in this formula. We have E over V. E is just equity, and V is the total volume, and this is the cost of equity, and we have debt and divided by the total value, the total fund risen, and this is the cost of debt, and this is the effect of the taxes which is deducted from the interest. I'm just explaining it here, don't worry about it. I'm just explaining it simply step by step. Okay, dear students, first, why we are using weighted average? Okay, we have two types of averages. Simply you can say a simple average, and we have weighted average. Why we are using weighted average here in this example, or in finance? Okay, first, I'm just explaining here with a simple example. For example, if there are two groups, or you can say two classes, right, or two groups in the classes, right? Simply in one class there are 60 students, right, or you can say there are 80 students, and in another class there are 40 students. Okay, these students, they have secured the average mark in English, for example, that is how much in English subject, that is 20, and these students, they have secured average marks, that is how much, that is 40 or 30. Okay, dear students, we have the total, how many students we have? You can say 120 students, right? Okay, 80 students, they have secured average 20 score in English subject, and 40 students, they have got 30 in English, right? Now, these are the averages. 20 is the average of this group, and 30 is the average of this group. If you want to find out the average of both of these groups, right, in this situation you have to use the weighted average cost of capital, right? If you want to try to know how much is the average score secured by each student out of 120 students, we have total how much, 120 students, right? This is total. How much by average each student secured here? Then you need not to compute just the average of these two values. This is wrong. For example, if you just add these two values, for example, simple average is like you are adding 20 plus 30 divided by 2. The average is 25. What does this 25 mean? It's mean you have computed that by average each student, right, secured 25, but this is wrong, because we have taken just simple average of these two values, and this is wrong. We have not considered the weight here. Here is the weight 80, and here is the weight 40, right? Why it is wrong, I'm just explaining it here. For example, the total students we have is 120, and the total score, that is, I'm just trying to explain it how much. For example, how much is the total score here? The total score is 20 into 80, that is 1600. How much is the total score here? 30 into 40 students, that is 1200. And if you add both of them, that will give you the cumulative or the total score here, and that is how much? $2,800. It's mean 120 students, they have got 2,800 score in English, that is the total marks, you can say. Okay, if each student secure 25, right, just test it. So 25 multiplied by 120, that is giving you 3,000. This is wrong, right? This is wrong. Why? Because the total score, the total marks we have it 2,800, right? And there are 120 students. If you just try to know how much marks that is secured by each single student, that is 25. This is wrong, and this is what you have computed. You have added these two averages and divided by 2, that is 25. Because 25, if you multiply this back, right, with the total number of students, which is 120 here, right? Then that is not giving you 2800. That is why we say this average is not appropriate. We are using weighted average, right? And how to compute the weighted average, that is I'm just telling you. The weighted average is just the total score we have, you have to divide by 120. So we have 2800 divided by 120, and that is equal to how much? 23. This is called the weighted average. It's mean now you can say that by average each student has got how much? 23 score in English. If you multiply this 23 back with number of students 120, that is exactly giving you 2800. Dear students, that is why in some situations we try to compute weighted average, not simple average, as it is clear in this example. Same is the case here in our example here. Why we have to use weighted average in finance? The reason behind, because you try to know how much is the average cost risen against each dollar, right? Because maybe 50% or 60% of the total fund is risen from equity, right, and 40% from debt. So whenever the total volume, or you can say the percentages of both of them, that is different, so that is why you cannot use a simple average, you have to use the weighted average. Okay, for example, we have accounting equation like assets equal to liabilities and then equity. Okay, here you have 40,000 fund has been risen here, and 60,000 risen here. Okay, now if the cost over here is 4% and the cost over here is 7%, right? So again, once again, I'm just telling you simply that you cannot just add both of them and divide by 2 to compute the simple average. Like equal sign, we have 4% plus we have 7% and then divide by 2. This is wrong. You cannot say 5.5% is the average. This is wrong. You know why? Because we have not considered the weight here. 4% is for 40,000 liabilities, right? And 7% is for 60,000. So you cannot say 5.50% is the average cost for each dollar risen, right? Let me just test it why it is wrong. Because if you add the total capital we have, that is how much? That is 100,000, right? This is the total capital. And if you say that for each dollar we have risen, we have to pay 5.5%, right? Okay, so how much cost do you have to pay? So equal sign, this is $100,000 into how much? 5.50%, that is equal to 5,500. But this is actually wrong. This is wrong. Why? Because I'm just proving it. For $100,000 we are not paying 5,500. How much we are paying? I'm just computing it here. Equal sign, 40,000 multiply with 4%, this is equal to 1600. Now 60,000 multiply into 7, this is equal to 4,200, right? Now add both of them. When you add both of them, this is giving us the cost, the total cost. Okay, that is 5,800. Once again, dear students, it's mean $100,000 is the total fund, right? 40,000 we are paying 4%, 60,000 we are paying 7%, right? The average we are paying how much? 5.50%. It's mean for each dollar we are paying 5.50% is wrong, because when you multiply this in order to compute the cost, that is giving you 5,500, while the actual cost we are paying is 5,800. Why? Because here look, we have 1,600, that is the cost we are paying to liabilities, to debt, and this is the cost we are paying to equity, and the total we are paying 5,800. But the average which I have computed, when I multiply this back with $100,000, is not giving me this actual cost, which is 5,800. So that is why the simple average is not appropriate. Which kind of average we have to use? We have to use the weighted average. What is the weighted average in our example here? In our example is the total cost is how much? 5,800. And how much is the total dollar? $100,000. So when you divide $100,000 over the cost, sorry, when you divide the total cost, which is 5,800, the actual cost over $100,000, so it's mean against each dollar we have risen, the cost is how much? The cost is 5.8%, not 5.50%. 5.5% is wrong and 5.8% is correct, because this is weighted average. Here we have considered the weight, these two are weight, okay, which is 40% and 60%. Okay, dear students, this is only the story behind why we are just using weighted average and why we are not using the simple average. Okay, now I'm just coming into this function or formula. In this formula, dear students, as you can see, WACC, we have the cost we have to pay to the equity, and we have the cost we have to pay to the debt. Okay, and we multiply both of them with weight, right? And then we add them together, and this is giving me WACC, or weighted average cost of capital. Okay, how this is done? First, all the information which is required in this formula, we have to extract it from here. Look here, the first we need to know about the market value of equity, which is the equity in our formula, which is E. Okay, how you can compute this value? Okay, 1 million shares we have, right? So equal sign 1 million, just, okay, let me compute it here. 1 million into the price per share, that is $30. Okay, we are just raising $30 million from equity, or that is our equity finance. Okay, how much is debt? Okay, 50,000 we are just issuing by the market price. What is the market price? That is 950. So you can say 50,000, right, into market price 950. Okay, this is 47,500,000. okay, the total value, just add both of them together, this is the total. Okay, the total equity, and this is the total market value. We have just extracted this information from here, and this is the total market value. Okay, so you can say we found this portion, right, because total V is the total, that this is V, right? We found this portion, right, and this is the portion, this is E over V. E we found it, this is E, and V we found it, this is V, and D we found it, this is D, right? Okay, now what is remaining here? Now we need to compute RE, which is the cost of equity, and RD, and then TC is given. Okay, look, dear students, how? Okay, dear students, for the cost of equity RE, we have a formula, we have a model by the name of CAPM model, and you have to compute RE by the help of CAPM model. And how that is done, I'm just explaining it, right? Okay, first here I'm just computing cost of equity. Okay, how we have a function formula, we have a model. If you remember, RE, cost of equity, that is the financial management, I have already explained. RE, that is equal to RF plus beta into RM minus RF. Okay, dear students, if you remember, in the CAPM model we try to find the minimum cost of equity and the cost of the capital, so we are just using this formula. Okay, RE, in our question RF is given. How much is RF, risk free return, that is 4%. Okay, plus beta is 1.2, and then RM minus RF, this is called risk premium. The risk premium is given, and that is how much? 8%. Okay, now RE, which is the cost of equity, that is equal to how much? Okay, simply copy this value here. Okay, that is equal to 13.16%. So dear students, we found RE. RE is the cost of equity. What does this mean? Okay, you must know first what is RE or what is CAPI model and how you can find out the cost of equity. So we found 13.16. What does this mean? It's mean the minimum cost we have to pay to the shareholder, right? Or this is the cost of equity, that is 13.6%. okay. Now we come to RD, which is cost of debt. So look dear students here, how you can compute cost of debt. Cost of debt, okay. Okay, for the cost of debt, if you remember, we have the concept of YTM, yield to maturity. In our example, first we should know about some information which is given here. That is, first we have the face value of the bond, which is 1000, right? And we have the coupon, which is 10%. 10% is equal to $100, 10% of 1000, and we have the market value or the price of the bond, that is $950, right? And we have years. Okay, how many years? That is, you can say 20 years. Okay, this data we found, and we need to know about RD, which is the cost of capital, dear students. What is the cost? The cost of debt. What is the cost of debt? It's mean if you raise, this is not 20%, this is just a minute. This mean if you purchase as a bond, right, for $950, right, and you keep it for 20 years, right, and each year you're receiving $100, and at the end of the 20th year you are just getting 1000, right? It's mean, what is the YTM? What is the cost here? Cost of the capital, cost of the debt you are paying here. Okay, okay, we technically RD we also call it YTM, yield to maturity. Okay, how you can compute YTM, yield to maturity, dear students? First I'm just explaining the concept of YTM. For example, we have years, we have cash flows. Okay, okay, starting from zero. Today I'm just investing how much? I'm just purchasing a bond for $950. So I'm paying, when you are paying, so that is negative value, $950, right? And after 1 year I'm receiving $100 in the second, sorry, I'm receiving $100, and the second year again I'm receiving $100, right? Okay, so it's mean this goes for 20 years, right? Here is 20. Okay, okay, you are receiving 100 each year for 20 years, and the 20th you are receiving 1100. You know why? Look here, it's mean today you are just paying $950 and you are getting $100 at the end of each year, and at the end of 20th year you are getting 100 plus 1000. Why? Because the face value in our example, as I've explained here, the face value how much? That is 1000, right? It's mean if you keep this bond for 20 years, at the end of the 20th year you are getting 1000. Okay, okay, so this is the idea and the concept I'm just trying to explain here, dear students, that if you want to make investment in the bonds and the price is $950 and you are receiving at the end of each year $100 for 20 years. Okay, so what is the rate used here? What is the rate? What is the internal rate used here? If you remember, IRR, internal rate of return, and yield to maturity, the concept is the same. So the rate is actually the cost of this investment, and that is called RD. This is what we are paying to this bond. So we have a formula here in Excel. If you manually do this, we have here we have formula for YTM. This is if you just try to do it manually. Okay, Okay, look here. Deriving YTM by interpolation method, if you remember, like IRR, when we try to find out the internal rate of return, or we try to find out YTM, so we have a trial and error method, as you have studied in present value or internal rate of return. We have to go to trial and error method. You have to find out the lower interest, the higher interest, one value which is computed by lower interest and the higher interest. In between we try to interpolate. This is totally a different lecture. I have it, you can just find it out in my channel by the name of IRR, internal rate of return. The same concept, YTM and IRR, they are same. But anyhow, I'm just not wasting your time how to compute YTM. Okay, in this example, if I'm just making simple, for example, what is the idea? You try to find out the price. Okay, this is the price of the bond which is given, the future value which is cash flow at year 1, then divide by 1 less, which is YTM, which is internal rate of return, right? We have already explained. Okay, this is raised into power 1, and plus then the coupon, which is cash flow in year 2, divided by 1 plus 1 less YTM, right? Which is YTM, sorry for my handwriting, raised into power 2. This is raised into power 2, and this goes for 20 year, right? This goes for how much? 20 year. Finally we have CN, right, plus future value, which is face value in year N, and this should be divided by 1 plus YTM. Okay, so sorry for this. Okay, which is YTM raised into power N. Okay, dear students, very much simple. These are the cash flows you are just getting each year, and we try to discount all the future cash flows and try to find out the YTM. So in our example, the P is given, which is the price 950, the C1, C2, C3, these are the cash flows, they are given, and for 20 years the face value at the end of the year is given, right? And one thing which we try to find out is YTM, that is missing, right? So we have simply a function or formula by the name of IRR. Simply write IRR, type IRR, and check all these values in the range, and this will just find out how much is YTM, or the cost of the debt we have to pay in our example. Okay, that is 10.61%. Okay, dear students, now we try to find out WACC. How we can compute WACC, which is weighted average cost of capital. Okay, we are using this formula, this function. Look, first we have E over V. E over V, the E is given, equal sign, E is equity, that is this value 30 million. Okay, check in the bracket as it is in the bracket here. E, this is 30 million, or V, which is the total value, into multiply into RE, which is the cost of equity we found, right? And plus then we have, start again the bracket, we have debt value, and this will be divided by the total market value, right? And then multiply into RD, which is the cost of debt, right? But keep in mind, this the cost of debt should also be multiplied into 1 minus TC, into 1 minus TC, which is corporate tax here, sorry here, 1 minus TC, the TC which is the corporate tax here. In our example, just a minute, in our example that is 35%, okay, 35%, or you can say 0.35. okay, press enter. That is equal to, look, this is 35%, is equal to 9.49%. okay, this is WACC. okay, question, why we are just multiplying the RD value with 1 minus, because the RD is the interest, right? This is the interest, the cost of the debt we are paying, and you know the cost of the debt is the tax deductible. So that is why we are just subtracting the effect of the taxes, because we are paying the interest before taxes, so we are not paying the taxes for the interest. So the effect of the taxes should be subtracted from the cost of the debt in order to reduce this cost. So we say we are not actually paying 10.61%, because 35% of taxes we have not paid, right? We have not paid for this interest. So that is why we say we are not actually paying 10.61% to the debt. We are paying 35% less. The reason behind, because we have paid it before taxes, we have not been charged the taxes for. So that is the effect of the taxes we have, which is called the tax shield we have received. That is kind of benefit we have received because of this interest tax deductibility. So we say from the interest we are paying to the debt, we are just subtracting the effect of the taxes. That's the logic behind. Okay, so finally we have WACC, which is 9.49%. this means, dear students, by average we are paying to each source of financing 9.49%, right? It's mean by average we are paying to equity how much cost, 9.49%, and also we are paying how much to debt, we are paying 9.49%. or in other words, the total fund we are raising 77,500,000. for each dollar, by average we are paying how much cost, 9.49 cost. Okay, so dear students, I hope the idea is clear here. You have learned how to compute WACC and what is the concept and the idea of WACC. If you want to prove whether this is really an average of the capital, you can prove it. For example, you can find out first the cost. Here I'm just doing it. Okay, you try to find out the cost of equity and then find out the cost of debt separately. The cost of equity is how much is the equity? This is equity, just multiply this with the cost of equity, which is 13.6%, right? And how much is the cost of debt? The debt is, this is the cost, and then multiply this with RD, right? And also multiply this with 1 minus 0.35, because this is tax deductible. So you can say how much total cost we are paying. Just add both of these values. Okay, look, I'm just adding these two values. It's means the total cost I'm paying, this is the total cost I'm paying, right? 7,356,460.7. this is the average cost I'm paying to this is the total cost I'm paying for this fund I'm raising, 77 million fund I'm paying this cost. Okay, how much is the average for each dollar? This is 9.49%. okay, let me test it whether it is true or not. Okay, using this function, yes, you can use it. Okay, have look, equal sign, take this. Okay, I'm just checking it here. Okay, how you can know whether it is giving us the total cost or not. Okay, equal sign, this is 9.49%, multiply this with the total market value. This will give us exactly the same value. Look, this is 7,356,000 and this is 7,300,000. It's mean if for each dollar I'm just paying 9.49%, and the total dollar we have is $77,500,000. So how much is the total cost? I'm just multiplying this percentage with this value. This is giving me the total cost. So that is why we say this is the weighted average cost of capital. If you are just using a simple average here, is not giving you exactly this total cost. That's the logic behind WACC. I hope, dear students, you have learned what is the concept in the idea of WACC, and if you still have any question, you can ask me. Have a nice time and wish you good luck. Assalamu alaikum warahmatullahi wabarakatuh.